Good afternoon. I'm Sean Gregory, Managing Director and CEO of Barra Resources. Today I'm going to be telling you about our plans to take the Mount Thirsty project, cobalt nickel project, into pre-feasibility study this year. We've also got RC drilling just about to kick off on our gold assets just near Coolgardie. So we've got a dual commodity strategy. I'll tell you about that. It's the cobalt nickel story and it's also the gold story. A full range from greenfields exploration, brownfields exploration, through to a real project development story with the Mount Thirsty project. We're in the best mining location in the world. We're in WA's goldfields, of course, right next to existing infrastructure. Roads, rail, pipelines, water, it's all there, gas, the lot. Stable and ethical mining jurisdiction, of course, which feeds into the cobalt market dynamics. I'll tell you about that, I'll tell you about the demand side and the supply side, and I'll tell you why cobalt represents a special opportunity. And importantly, we're here to do the work. We're diving into our pre-feasibility study. In the next month or so, we'll be kicking that off, and we'll be doing some gold drilling as well. So as a company, we've been around for quite some time. First listed on the stock exchange in the year 2000, and the assets were all born out of the old Barminco, Australia's largest underground mining contractor. Those gold assets and through those strategic partnerships were brought into production, and gold was produced through 2006, 2007. That relationship is still very strong, and Peter Bartlett is still on our register via his private investment vehicle, FMR. That gives us an opportunity to leverage into that mining capability, to leverage into those mills. There's mills right next to Burbanks, and there's other mills owned by FMR just down the road. The rest of our shareholder base is wide open. We've got 3,000 shareholders, and they've been very, very supportive to us. In just October last year, we tapped our loyal shareholders via a share purchase plan. We went out there for $1 million and were overwhelmed with subscriptions for $3.8 million. We took 2.25 of that, and we're presently sitting with a healthy $2.4 million in the bank. Experienced board and management team, and they've seen fit to bring me on board. I've come on board now. This is my third week with the company full-time. I've come out of a background of project development, starting projects with BHP, working on big feasibility studies with Murchison Metals, and then working with the can-do logic, can-do mentality of one of Australia's biggest mining services company, Mineral Resources. So the electric vehicle story. I won't labour this point, you've all heard it before, and it's a very, very compelling story. Just a couple of points. It's all being driven by the government mandates in China and India. 12% electric vehicles in China by 2020, and 100% electric vehicles in India by 2030. Of course, the automakers have responded. All of the big names have set themselves very, very aggressive targets. As an example, Volvo will be making, all of their cars will have some electric vehicle component to them. It's all about the cost of the batteries. $1,000 per kilowatt hour for a battery in 2010. Today, that's only $200 per kilowatt hour. It's going to reach parity with internal combustion engines within the next few years at around about $100 per kilowatt hour, and we'll see the huge market penetration of electric vehicles. That's happening. But where does cobalt fit into that story? In your iPhone, you've all got one in your pocket, about $1 of cobalt in your iPhone. Tesla electric vehicle, 2% of the value of a Tesla electric vehicle, their economy model, is the value of the cobalt. So as the price of cobalt rises, as it invariably will, customers are going to be unperturbed by that change in price. Apple will not mind if the cost goes from $1 to $2 to $3 in a $1,000 product. Now, it's not just about the batteries. Cobalt's been around for a long, long time. There's 34 other industrial uses for cobalt: hard metals, superalloys, ceramics and the like, and we're not in a boom for cobalt. This is not a bubble. I've got a chart there that shows the 120-year price history for cobalt. Right back to 1900. You can see the price has gone up and down, but presently, where we're at, in real terms, about $80,000 US per tonne. That's within the range of the normal trading range of cobalt. There's still plenty for a re-rating on the back of electric vehicles to happen. The supply side, that's a really other important side of the dynamic. 97% of all cobalt is a byproduct of nickel and copper mining. These miners need the price of copper and nickel to rise to justify new investment. Our project, which I'll get onto in a minute, is more heavily leveraged to the cobalt price. Cobalt makes up a far greater proportion of our revenue and will be best prepared to fill that demand need. Other projects also have a very high capital cost, a high barrier to entry. Ours is $212 million, very, very modest in this space, and I'll run through that in a minute. There's, of course, the story of the DRC as well. 56% of all cobalt comes out of the DRC. Of that, 20% is artisanal miners. 40,000 children are employed in that industry, and UNICEF estimate that number. They also estimate $1 to $3 per day. The Apples, the Samsungs, the Volkswagens, the GMs, they're not going to want to be involved in that story, nor are the funds that support them. So we really see cobalt emerging, not so much being a price story, it's a security of supply story. These big companies are going to need cobalt, and they're going to be wanting to put their foot on these deposits like Mount Thirsty that can come to production very, very quickly. And of course, there's the recent price chart. Absolutely, cobalt price has tripled, totally consistent with where cobalt's been the last 120 years. So moving on to our project, Mount Thirsty. 32 million tonnes at 0.13 cobalt, 0.55 nickel. The project's located only 14 kilometres from Norseman, 4 kilometres from the highway. Very, very good location. All of that infrastructure is there. Low strip ratio, 1.5 to 1. Very, very soft, friable material. There's an upper goethite and an upper limonite horizon, very, very powdery material. Minimum crushing and blasting. The cobalt grade is roughly double that of a typical laterite project in Western Australia. Now, laterite's a broad term, it refers to the weathering profile. We refer to ours as more an oxide mineralisation. The laterite above our deposit is actually our waste rock. We're in the oxide zone, fully oxidised material, manganese minerals. There's a mineral in there called absilane that hosts the manganese and the cobalt, which is amenable to agitated atmospheric leaching. Just over our tenement boundary, Mark Creasy has got 20 million tonnes of resource as well. We understand they're about to IPO that particular project. More excitement around the deposit, more excitement around the region. In October, we published our scoping study. Highlights for me, very, very cheap capital, $212 million to get a nickel cobalt project off the ground. Conservative economic assumptions. The cobalt price there, $72,000 US per tonne. Today's spot price is $81,000 per tonne. That healthy NPV, $290 million, is based on relatively modest recoveries. We're getting 73% of the cobalt and only 21% of the nickel. As we dive into the pre-feasibility study, we'll be exploring ways to increase those recoveries. And we've got some really good ideas based on some old test work from 2009, 2010. And there's a real opportunity to get those recoveries up and or improve the already impressive economics. So we're about to launch into it. We're out there talking to your top tier mining engineering houses. We really want to get a good brand name on that pre-feasibility study, but I'll also bring my fit-for-purpose approach to it to make sure that we get maximum value out of that study. We'll be looking at a wide range of flow sheets. The scoping study was on a sulphur dioxide reagent, very, very promising, our preferred reagent, but there's this option also to add some sulphuric acid on the back end. And we'll look at other flow sheet options as well. The mine plan. At the moment, the mine plan is a very, very simple mine plan. We'll be pulling that ore body apart, we'll be domaining it, we'll be looking for opportunities to get in-pit tailings, all of those good things to get some value out of the mine plan. A lot of value left on the table there. And importantly, as Barra, as a small ASX junior company, a development at the smaller end of the capital range may well be within our reach with some partners, but there'll also be other options for larger flow sheets with improved metal recoveries that may well be more suitable to your large multinational corporations. We'll be catering for all those needs and delivering a pre-feasibility study to enable our partners to choose their own adventure in terms of the ultimate development of the project. Moving on to our gold assets. Our gold assets are located in and around Coolgardie. Again, we all know, famous mining district, a lot of good real estate around, a lot of good infrastructure around. There's a mill right next to our Burbanks deposit, and of course we're leveraged into the FMR-owned mills as well. And we're going out there drilling. In just a couple of months, we'll be out there drilling. 400,000 ounces have come out of our gold deposits in Coolgardie. Includes the Burbanks deposit, which is a 5 kilometre long shear zone. It includes the Birthday Gift mine, very, very high grade, 27 grams per tonne, one of the higher grade mines in the region. We just recently reacquired the Birthday Gift mine, brought that one back into the stable. And importantly, that provides not only 95,000 ounces of JORC resources, but it also provides a springboard to access the future discoveries that we're chasing immediately next door. Phillips Find is more at the greenfields end of the scale. There's certainly been some mining out there. There's 3 open pits. 33,000 ounces came out of those 3 small pits. The underground potential below that, never been tested. To the north of that, we've also got a big target called Truth. It's 6 kilometres long, 1.5 kilometres wide, and very, very structurally complex. It's not just the 6 kilometre strike length that is of interest, but there are 8 fold and thrust systems all stacked up on top of each other. So the structural strike length is very great indeed. Diablo is more of a geochemical target, and all of these are crying out to be tested. So we've got an in-house exploration manager who's been with us 14 years, got a great bunch of knowledge in-house, and we also brought in a fellow called Alan Neeshaw, former VP exploration with Anglo. And together they've come up with a gold exploration strategy for these projects. We've gone through and whittled them down, prioritised where we're going to spend our money this year with our drilling, and we're going to kick things off at main lode. The board's already approved 4,000 metres of RC in there, and we'll be getting out there as soon as we possibly can in April this year, drilling that one. And we really think I'd very much like to get some runs on the board early, and that very much being at that brownfield scale, very high probability of getting some high-grade hits. And as we move throughout the year, we'll also be testing some of the more exciting greenfields projects as well. So zooming into main lode, and there are a couple of long sections on the screen there. You can see the underground workings, you can see the existing mineralisation, you can see the existing resources as well. And you can also see the paucity of drilling. You've got these gold centres and these historical gold mining areas with very few and typically no drill holes between them. We'll be filling those gaps and starting off at main lode there as we zoom in at that closer range cross section. That's a long section, and the red dots on the map there are the pierce points where our drill holes will hit the structures of interest. And again, those established underground workings, it's only a hop, skip and a jump to be able to access that mineralisation. So the value proposition for Barra Resources. Now I've got a chart there that indicates where we are in terms of the scheme of our peers, in terms of the other cobalt companies out there. The triangles represent our grade, so we're certainly well up above double the typical grade within a oxide or laterite nickel cobalt deposit. Importantly, not just about the grade, it's also the mineralogy, and we can access that cobalt at agitated atmospheric leaching. We're the red one there, and absolutely we're cheap on the metric of enterprise value per cobalt tonne in the ground. Now, we're not here to complain about that. We're here to tell you about our future plans, and we'll be working our way right up that value curve as we do our hard work through our pre-feasibility study, and as we get our gold results coming through with regular news flow, we'll be working our way up the curve. There'll be further development of the electric vehicle story that'll become more and more real. The cobalt price will continue to appreciate for the reasons I described, and we really think Barra represents great value investing, and please come and have a chat to us at our booth near the bar. Thank you.